On Thursday, April 16th, Arxis opened for trading on the Nasdaq. The IPO had priced the night before at $28 a share. The first public trade crossed at $38. By the end of the day, the stock was up 36%. The next morning, 7 insiders filed Form 4s disclosing that they had just bought $5.6 million of stock at $28 each. The market was paying $38. They paid $28. The filings will tell you why. Arxis is an aerospace and defense components manufacturer based in Bloomfield, Connecticut. 47% of their revenue is defense and space, 23% is commercial aerospace, 30% is industrial technology, 5,000 customers, more than 600 different platforms, meaning the specific aircraft, missile systems, and industrial machines their parts go into. No single customer generates more than 7% of revenue. That matters. It means this isn't a company tied to one program that could be cut. What's unusual about Arxis isn't the business, it's the ownership structure that brought them public. Since 2019, Arxis has been owned by Arcline Capital, a private equity firm, and has grown through more than 30 acquisitions, including the $1.8 billion purchase of Cayman Aerospace in 2024. Goldman Sachs, Morgan Stanley, and Jefferies underwrote the IPO. The offering raised $1.13 billion at an $11 billion valuation. That's the context for every number that you're about to see. On April 17th, the second day of public trading, 7 insiders filed Form 4s. Director Kevin Parmhaus bought $1.5 million of stock. Director Stephen Oaken, $700,000. Director Patrick Allen, $280,000. Chief Accounting Officer Ryan Jankowski, $125,000, and 3 other insiders, Jason Roth, Azad Badigash, and Ross Steelfon, put up roughly $3 million combined. Every single purchase was executed at exactly $28 per share. Not $28.03, not $28.50, $28 flat across all 7 insiders. The uniform pricing tells you these are directed share program purchases, and if you saw our HMH video, you've seen this before. The underwriter, Goldman Sachs in this case, reserves roughly 5% of the IPO allocation for insiders and affiliates, sold at the IPO price set before trading begins. But here's what's different from HMH. HMH priced at $20 and opened at $18.90 below the IPO price. Insiders who bought through the directed share program were upside down within hours. Arxis priced at $28 and opened at $38. By the time these 7 insiders filed their paperwork, the shares they'd bought were worth $10 more each than what they'd paid. On paper, unrealized, locked up. These 7 insiders are locked up for 180 days. They can't sell until mid-October, regardless of what the stock does, which means the $10 gain on paper is theoretical. The only gain that counts is the one that still exists in October. That makes the size of each commitment the real signal. Director Parmhaus wrote a personal check for $1.5 million at IPO price, knowing he couldn't touch it for 6 months. Director Oaken, $700,000. These aren't token buys or compensation events. These are board members choosing the IPO as an investable entry point with 6 months of exposure to whatever comes next. And it matters that Arxis is a private equity exit. Arcline has owned this company since 2019 and rolled up 30 acquisitions inside it. The IPO is, in part, how Arcline starts getting out. So when directors write personal checks on the way public, they're signaling alignment with shareholders, not with the sponsor who brought the company here. Here's the framework. When you're reading a Form 4 tied to an IPO, 3 numbers tell the story together. The offer price, which is what the insider paid, the opening price, which is what the public paid, and the lockup period, how long the insider sits with the gap between the two. HMH priced at $20 and opened below it. Insiders were underwater on day 1. Arxis priced at $28 and opened at $38. Insiders have a $10 paper cushion. Same structural transaction, opposite starting conditions. Neither is better. They're different kinds of conviction, buying into weakness versus buying into strength, and they resolve differently. If Arxis closes near 38 in October, the directed share program was a quiet gift. If it closes near 25, these 7 insiders will have held stock they couldn't sell through a 20% drawdown. That's where the real signal lives, in the scenario they can't escape from. The headline is $5.6 million of insider buying at a hot aerospace IPO. The story is the $10 gap in the 6 months that will decide whether it means anything. This video is for informational and educational purposes only and does not constitute investment advice. InsiderCompass is not a broker-dealer or registered investment advisor. Data is sourced from public SEC Form 4 filings. Insider activity does not guarantee future performance. Always do your own research.